Something is not right. Something is and you don't worry. Your husband wants to see you.
Good evening, class, and welcome to our performance management lectures today. The topic that we are going to be considering today is standard costing and variance analysis. Now, standard costing and variance analysis is one important topic that you should pay attention to. In fact, for the next 4 classes, okay, starting with this class and 3 on variance analysis. So it is so important that we need to take our time to learn it so well. Now, let's start with standard costing. What is standard costing? Standard costing is a way of getting the standard price and standard production costs of one unit of a product. So let's look at bread, for example. A loaf of bread, the price for the loaf of bread in the market is called the standard price. What about the production costs of making one loaf of bread? That is called the standard cost or standard production cost. So let's look at bread typically in this example. You want to make a loaf of bread, you need to consider the materials that will be used to make that bread. What is the standard quantity that will be used? So it means that how many grams or how many kilograms will be used to make one loaf of bread. That is the standard quantity. Then how much do you buy 1 kilogram of materials? That's the standard price. So when you multiply the standard quantity with the standard price, you get the standard material costs. Then you want to make bread, you will need labor. What is the standard labor hours to make one loaf of bread? When you know the standard hours, how much do you pay those laborers per hour? That will be your standard cost. So when you multiply the cost with the number of hours, you get your standard labor cost for one loaf. The same thing you do to your variable overheads. You use your labor costs, labor hours multiplied by the variable overhead standard cost. You do the same thing to your fixed overhead or fixed production overhead. When you add all these costs together, you have what they call the total absorption cost. Okay, when we get our standard costs, we are ready to make a budget. So there is a similarity between a budget and a standard cost. Now, standard cost or standards, standard price, standard cost, all form standards. A standard is the unit for evaluating one unit of a product. So when we say standard costs, you will also follow it with one product. So a standard cost of one product or a standard price of one product. Budget is the application of standards to more than one product, to more than one quantity, sorry, one quantity, more than one. So when we say standards is for one unit, budget is for more than one unit. So what it means is that if you want to make 10 loaves of bread, and the standard cost to make one loaf of bread is 50 naira, it means the budgeted cost for 10 loaf of bread will be 50 multiplied by 10 loaves of bread, which is 500 naira. So that's how we get the difference between a cost and a budget. Budget is derived from standards. And so budget is built up by standards. That is what we call a fixed budget. What is a fixed budget? A fixed budget is a rigid budget that is prepared for a predetermined number of quantities, a predetermined number of quantity, and it is rigid. When we say rigid, it's not flexible, it does not change. It's not flexible. All right, so let's look at example number 1 to illustrate how a fixed budget is prepared. Example number 1, standard costs and fixed budget for a period. Lagos Manufacturing Limited has budgeted to make 1,200 units. So you hear the word budgeted to make. So that's a budget. So you see it is more than one unit. Okay, budget is for more than one. So they budgeted to make 1,200 units. And they also budgeted to sell 1,000 units in January. The selling price per unit, now that's standard when you see per unit, the selling price per unit is budgeted at 15,000. So even if they use budgeted, but it is per unit, you know it is standard. So the standard selling price here is 15,000 naira. The standard costs of production are as follows. So now you have standard. So all your mind will be thinking about one unit. So even if they didn't tell you per unit, your mind is thinking per unit. Direct materials. It means here that 1 unit of these products, we don't know the name of the product. I want to call it bread. Maybe I like bread so much. 1 unit of bread, in our example here, uses 5 kg of direct material. And now 1 kg costs us 1,000 naira. And so 1 unit direct material cost is 5,000 naira. That's standard. Direct labor hours. So direct labor, it takes us 4 hours to make a loaf of bread. And we pay our laborers 500 naira per hour. So when we multiply 500 naira by 4 hours, we have 2,000 naira labor costs for 1 loaf. Variable overhead, we are still taking direct labor hours, 4 hours. But now for those variable overhead, we are paying 200 naira per hour. And so it costs us 800. So when you add all these variable items, we have material, labor, and variable overheads. We have 7,800 naira as the marginal production costs. Now let's go to the fixed cost here. Fixed overhead, we're still talking about the direct labor hours, 4 hours, but now we have the 600 naira per hour as our fixed overhead absorption rates per hour. So that's the fixed overhead absorption rate. And it gives us 2,400. When we add the fixed cost to our marginal production cost, we have a total absorption cost of 10,200. It means in this our bread, our special bread, one loaf cost us 10,200. Wow, that's fine. And our standard selling price is 15,000. Okay, now let's go to the budget. The budget prepared for January is as follows. Now we budgeted to sell 1,000 units as stated in the beginning of the question, and the budgeted production is 1,200 required. Prepare a fixed budget for the month of January. So how do we prepare a fixed budget? Let us see. Let's see how we prepare a fixed budget. Solution. Now, in a fixed budget, we have the 2 naira sign and we put 3 zeros because we don't want to have large numbers in our solution. So we've reduced it by putting 3 zeros up. Now, our sales revenue, budgeted sales revenue, we budgeted that we will sell 1,000 units and we are going to sell them at 15,000 naira. So we multiply them together, we have 15 million. So that's 15 million here. Cost of sales. We decided that we want to produce 1,200 units. And so materials for that 1,200 units will cost us how much? We said before that 1 unit cost us 5,000 naira. And so if we are to do 1,200 units, we are going to multiply 5,000 by 1,200 units, which gives us 6 million. Labor, we're still going to do 1,200 units. We will undergo labor. Labor cost per unit is 2,000 naira. So when we multiply, our labor cost will give us 2,400,000. Variable overheads, 1,200 units multiplied by 800 naira per unit gives us 960,000. And our fixed overhead, 1,200 units at 2,400 naira. That's the overhead absorption rate here. That gives us 2,880,000. Now, when you add all of these costs, that gives us your total absorption cost, 12,240,000. That is your total absorption cost. But now, there is a difference between the quantities we produced and the quantity we sold. We produced 1,200 and we didn't sell all, we sell 1,000. So by simple arithmetic, our closing stock will be a remainder of 200 units. So the 200 units that you remain, how will you value it? Now, because we are doing standard costing, we are going to value it at standard production cost. And what is our standard production cost? 10,200. The standard production cost is 10,200. That's what you use to multiply these 200 units to get 2,040,000. So when you remove your closing stock from your overhead costs, your absorption cost, total absorption costs, that will give you the cost of sales, which is 10,200,000. Of course, even without going this way, you would have gotten your cost of sales easily by multiplying 1,000 units, which is what is sold, because we are saying the cost of sales. If we have sold 1,000 units, how much did it cost us to make those 1,000 units? So that's why I see 1,000 units here, multiplied by the standard cost of production. You would have gotten your 10,200,000 without going through these hurdles of starting with cost of materials, labor, variable overhead, and fixed overhead. So that's it. We now have our profits of 4,800,000 naira, which is 15 million minus 10,200,000. That gives me 4,800,000. And that's your fixed budget. So did you see how we grew the budget from standard? So the standard is per unit, and the budget, we multiply each component standard cost by the quantity. So for sales, we multiply by the figure we budgeted to sell. For production, we multiply by the figure we budgeted to produce. And when we do that, you need to check if you have a closing stock so that you can remove the closing stock to get your cost of sales. Okay, so now that we've done a budget, a fixed budget, we will now need to see how a fixed budget and actual results look like. So why do we need to look at that? Because when you make a budget for production, sometimes you try to, control the budget so that you will, just a moment, please. Okay. All right. So you have a budget for a fixed amount of units. Like in this example here, in example 2, we budgeted that we are going to produce 1,200 and we are going to sell 1,000. But the actual result on the ground showed that we did not produce 1,200 anymore. We went ahead and produced 1,000. And instead of selling the whole 1,000, because we planned to sell 1,000, we ended up selling 900. So now, how do we put it side by side with the fixed budget? So look at it here now. In the example 2, we saw how we can put the fixed budget here. So the fixed budget is as we solved in example 1. Then in example 2, perhaps instead of selling at 15,000 naira, we decide to sell at a different price, smaller than 15,000. How much did we actually sell? Let's see, 12,600,000 divided by 900. So we sell at 14,000 naira. So that's what gave us 12,600. Then our cost of sales, our actual cost of materials was 4,608,000. Our labor, our variable overhead, and fixed overheads give us all of these. But something is similar between the budget figure and the actual figure. Something is similar. And what is that similar thing here? The closing inventory is at standard cost. The closing inventory is at standard cost. Now, if you look at the actual closing inventory of 1,000 units, is measured at the standard cost. And so that is what happens in standard costing. So when you are doing budgets, your closing stock will be at standard cost. When you are doing actuals, your closing stock will also be at standard cost. So you see that every other thing changes with the way the question is given to you. But when it comes to closing stock, remember to use standard costs for your closing stock. Don't forget that. If you fail to use standard cost for your closing stock, when you start doing variances and you start reconciling, your figures will not balance. All right, so now what does this tell us? This tells us that actual results differ from budgets. Now, the company has not achieved its plan in January. Why? Because the actual profit which we have is 3,446,000, whereas the budgeted profit was 4,800,000. And so the actual profit is less than what we budgeted. And so the company would like to understand the reason for these differences in profit. Why did we not achieve our targets? What could have caused those differences? So the technique that explains the differences between actual results and budgeted figures is called variance analysis. So when you see a profit figure different from budgeted figure for profit, different from actual profit figure, the only way to explain those differences is to conduct a variance analysis. So you see how we build it from standards to budgets, and now we are going to variance analysis to explain the differences in the two results. So these techniques called variance analysis identifies the components of differences between the budgeted figure and the actual profit in detail, so that these differences could be investigated and could be understood by the company. Now, the sales figure is less than the budgeted figure. Why? This is because the sales figure is a function of the quantity sold and the selling price. So why was the sales revenue different from in the budgeted and that of the actual? One reason is that the quantity sold in the actual is less than the budgeted. And also the price at which it was sold actually is less than the standard price it was sold. So you see, you have identified sales revenue as a line item of variance. You're now investigating, why is the revenue not 15 million, but it's giving you 12,600,000? You now investigated. You break it down to their components. Selling quantity, sales quantity. Oh, it's different. we plan to sell 1,000, but we actually sold 900. So that's one difference. What about the price? We plan to sell at 15,000, but now we are selling at 14,000. Oh, these two will be the differences. Now, at first sight, it looks as if the company has made a savings on every line cost, every cost line. For example, budgeted material cost was 6 million, but the actual spend was 4,608,000. So you see, we've compared sales quantity and we felt that the budgeted sales was higher than the actual sales. We now looked at the costs and we say, oh, our actual cost is cheaper than the budgeted cost. And we saw the example here of material. We budgeted to spend 6,000 naira, but here we are spending 4,608,000 instead of 6 million. Now, this is not a fair comparison. Do you know why? Because we budgeted to make 1,200 units, but the company at last made 1,000 units. So you don't expect the cost planned for 1,200 units to be smaller than the cost planned for 1,000 units. We expect the cost for 1,200 units to be bigger than that of 1,000. So it is not fair to compare these two budgets because they are at different level of activities. So one, it's not fair to compare the revenue because the sales quantity are different. It's not fair to compare the cost variances here because the production quantities are different here. Okay, so what do we do? Since we have an unfair comparison, there must be a way to make everything fair so that comparisons can take place. And so the only way to make it fair is to introduce what is called a flexed budget. A flexed budget. What is a flexed budget? Okay, a flexed budget is different from a fixed budget in the sense that a flexed budget is flexible. Is flexible. In the case of a fixed budget, we said it was rigid. We cannot change the quantity. But in a flexed budget, we can flex the budget in such a way that we can use it for variances. And so variances are not calculated by comparing actual results to a fixed budget because the figures relate to different levels of activities. So a second budget should be drawn up, which should be based on the actual level of activity. So if you want to compare a budget, a sales result, which shows you 900 units of items sold instead of 1,000 units. You need to flex your budget or make it flexible so that you will not start thinking, assuming I had planned for 900 units, how would the result be like? So that word, if I had planned for the 900 units that was actually sold, would the results be favorable or would it be adverse? Now, we produced 1,000 units instead of 1,200. If I had planned or made a budget for 1,000 units of production, would I have spent too much or little. So that's what we're going to do now. We are going to be looking at how to prepare a flexed budget. So that takes us to example number 3, the flexed budget. Now we can call it flexible budget. It is not rigid. Given the fixed budget in example 1, which is repeated in example 2, and the actual budget, which was shown in example 2, prepare a flexed budget for Lagos Manufacturing Limited at the end of January, based on the actual level of activity and standard revenue per unit and standard cost per unit, which will be used for variance analysis. Now let's go now and look at this example, example 3. We have a flexed budget, which has now been reduced. So you see that the fixed budget, the sales unit, then let's look at the fixed budget. The sales unit was 1,000 units. But now in the flex budget, it has been reduced to 900, which is the actual level of activity for sales. For production, the fixed budget told us it was 1,200, but now your flexed budget says no, let's bring it down to the level of actual activity, 1,000. So how will the budget look like? Now, since you are making your sales here, if you had sold 900 units instead of 1,000 we use in the fixed budget, if you have sold 900 units at 15,000 naira, your revenue will be 13,500. Now, instead of 30,500,000, instead of 15 million. Now, your cost of sales. If you have produced 1,000 units as against 1,200 you made in your fixed budget, which is so rigid that you can't change it, but now this flexible budget is flexible enough that we can bend to the level of actual activity. Now, if we had produced 1,000 units at a material cost of 5,000 naira per unit, we would have spent 5 million. For labor, the same 1,000 units would have spent 2 million. Variable overhead would have spent 800,000. And fixed overhead, we would have spent 2,400,000. When we add all of these together, our overhead costs, our absorption cost here will give us 10,200,000. Now, going to closing stock, don't forget this point. Your closing stock will always be at the standard cost of 10,200. Now, your closing stock now, instead of 200 before, is now 100. Why is it 100? Because our sales was 900 units, production was 1,000. So we didn't sell everything that we produced, so 100 remains. So that 100 is multiplied at the standard cost, and that gives us 1,020,000. So what will be your cost of sales? Your cost of sales is your this absorption cost here minus a closing stock gives us 9,180,000. And I told you it can be gotten directly because we decided that we are going to make 1,000 units, but we sold 900. So if we sell 900, how much did it cost us to make that 900 units we sold? Simply 900 units we sold multiplied by the standard cost, because this is cost of sales. So what is the standard cost? Multiplied by the sales quantity gives you your cost of sales. So that is the same thing we would have gotten if we have applied that method. If we didn't apply that method, we decide to use this absorption cost here to, and we remove this closing inventory, which we have gotten at our standard cost, we get the same thing. And then our profits will now give us 4,320,000. So you see your profit has dropped because you have done a flexible budget. Now it is this flexible budget that will be used for comparison with the actual result so that we can know if we have a variance. It's just like saying you want to compare two students. One of them is in primary school and the other is in secondary school. You say it's an unfair comparison. If you want to compare who of them is intelligent, you need to bring two people in the same class. So that's what we've done here. The fixed budget is of a higher class, but the flexible budget went to the class of actual spending or actual results in terms of production units and sales units. And now we can compare them fairly. All right. This shows that the amount that the company would have received for the actual number of units if they have sold at the budgeted revenue per item is what we have here as our budgeted sales, the flexible budget. And so we've talked about it, and we said it is at the actual level of activity. So flexible budget is a vital concept. So on your own, please get a fixed budget. Okay, the sequence is get a standard. That's the sequence. From the standard, prepare a fixed budget for some fixed production units and some fixed sales units. Make sure the production units is higher than the sales units. It could be the same. That means there'll be no closing stock. But if they are different and the production is higher than sales, you get a closing stock. Try that and get your fixed budget on ground. Now, normally when you get your fixed budget, you don't do a flexible budget immediately. You know why? Because you can never know your flexible budget as at the time your fixed budget is being made. It is at the end of the period when your actual result has been seen. That is when you can now make your flexible budget. So normally the sequence is you get a standard, you get a fixed budget from the standard, wait at the end of the period when you get your actual results, and you want to get a comparison with the budget, you now prepare a flexed budget, which you will use to compare with the actual result to see if you have variances. So it means that your variances will be flexed budget versus actual results. So can you now see how these three budgets are given here? The fixed budget and the flex budget and the actual budget and the actual result. So you can see that the sales revenue can be compared fairly. 13,500,000 versus 12,600,000. What is the difference? What causes that difference? You cannot explain. The same thing with other line materials and labor and others. So you can see before we said all the actuals in cost were cheaper than the fixed budget. But now when we are looking at flex budget, we found out that material budgeted cost for material is higher. That means we have an adverse variance there. Then when it comes to labor, we have Yeah, we have a favorable variance in material. When it comes to labor, actual now became higher. And so we have an adverse. We get down to variable overhead, actual now became higher. We also have an adverse. We get to fixed overhead, actual was higher, we had an adverse. So you see here that this is now far worse than the fixed budget. Now you need to explain. Now, because they are far worse, your profit now became smaller than the budgeted. So it means that your budgeted profit was no longer 4.8 because you use a higher standard, which is a fixed one. When you brought it down to the level of comparison with the actual, your budget feels like 4,320,000 profit. Now you are making 3,446,000 profit. Why? You need to explain. Now, all these things I've said here can be found in the commentary. Now, the variance analysis explains the difference between the fixed budget and the actual result in details. Both the fixed and the flex budgets are based on standard revenue and standard costs. Therefore, the difference between the fixed and the flex budget is caused only by difference in volume. And when we find a difference in the fixed costs, the fixed revenue amount, and the flexed revenue amount, let me show you. So the difference here between the fixed revenue here and the flexed revenue is caused by volume. Is caused by volume. So that is what we call volume. That is what we call volume, sales volume variance. And now the sales revenue in cost also, there's also differences in volumes that gives you different costs. So we'll talk about it later when we go deep into variance analysis. So now let's start by looking at the variance analysis. And before we talk about cost difference, let me first get the sequence. You will be given your standards. So that's the first thing. Look out. Variances always come in the same way. Look out for your standards. How do you get your standards? Standards is for 1 unit. So watch out for that. After you get your standards, look out for budgets. Look out for budgets. And now, when you do get a budget, remember, you'll be comparing a flexible budget with an actual budget, with an actual result. So if you do a fixed budget, remember, you still need to do a flexible budget. Look out for actual results. So it means in variances, you get standards, budget, actual. That is the way it goes. Now, in standard costing variance, cost variance, what we are talking about now, adverse and favorable cost variances of outputs are valued at their standard costs. Cost of production and cost of sales are therefore valued at standard costs. Now, the actual cost will differ from the standard cost. And so a cost variance is the difference between actual costs and standard costs. So it means that if the standard cost of an item. As in this case here, the standard cost of an item happens to be 5 million here, and the actual cost happens to be 4,608,000, then there is a difference, a variance. So we need to explain that variance. When the actual cost is higher than the standard cost, the cost variance is adverse. So it means that we plan to spend money on a particular amount of materials, maybe for 1,000 kilogram of material, we plan to spend a particular amount of money. And in the actual sense, you now spend higher than that. That means your actual cost is higher than what is budgeted. It's adverse. But when the standard cost is higher than the actual cost, then it's favorable. It means what you spent is less than what you budgeted. Different variances are calculated relating to material. So we have material variance, we have labor variance, we have variable overhead, variable production overhead variance, and fixed production overhead variance. We also have sales variance. All of these will be discussed. In a cost accounting system, cost variances are adjustments to the profit in an accounting period. And so it means that whenever you have a favorable variances, if you add your favorable variances to your profits, your favorable variances will increase the profits. So if you reported a profit and you now find out that you have variances, you trace it and they are all favorable variances. If you add them to the profit you reported, your profit will increase. When you have adverse variances, it should be reducing your profits. So we are going to be doing variance analysis now and performance reporting. So variance reports are produced at the end of each control period, say each end of each month. So at end of each month, what do? You have your fixed budget before, you now have your actual results, you now flexed it to your flexible budget, then you produce your variances. So that variances you have produced is your variance reports. The large adverse variance in your reports indicates poor performance, and management will need action on that. So they will need to take control action to ensure that these poor performances do not repeat itself again. Now, if there are large favorable variances, it indicates unexpected good performance. So management will want to consider, how did this good performance come unexpectedly? Can we maintain it in the future? Now, variances might be reported in a statement for the accounting period so that it can reconcile the budgeted profits with the actual profits. So when we do your variances, it will reconcile your fixed budgets, not your flex now. Your flex is used to get the variances. When you've done that, the variances will help you to reconcile your fixed budgets with your actual results. So because it is your fixed budget you did in the beginning and you got your actual result at the end, the flexed budget is just to help you to get your variances. So take note of that. Let's look at direct materials. So today, our discussion this night will be centered on just material variance. Now, I want you to take note of how we treat material variance, because it will be a way I will be treating most of the cost variances. So if you understand direct material variance, then you will understand labor variance, variable cost. Then you will need to also pay attention to fixed costs so that you can understand. That will be the topic for next class. But today, we are going to spend time on direct materials. The total direct material cost variance is the difference between the actual material cost in producing units in a period and the standard material cost for producing those units. So you have a standard cost and you have an actual cost. You find the difference. And look at the illustration. You look at the format here. Standard material cost of actual production. Now take note of that word, for actual production. What does it mean? It means you have done your flexible budgets, because your flexible budget will be based on actual production. Standard material on actual production, that is for flexible budget. But when you hear standard material for standard production, that is your fixed budget. All right, so your standard material of actual production, what does it mean? The actual units produced, not the standard now, the actual units produced multiplied by the standard quantity for one unit multiplied by the standard price. That will give you a figure. Then the actual material cost of actual production. So the actual units produced multiplied by the actual quantity per unit multiplied by the actual price. That will give you something else. So when you find the difference is called your variance, your direct material cost total variance. Now we can summarize this way by saying, using the formula method, we have total direct cost variance is SQ, that is standard quantity, multiplied by standard price. Meanwhile, this standard quantity is standard quantity for actual production. So standard quantity for actual production times standard price, now minus actual quantity for actual production times actual price. So if the variance is adverse, that means the actual cost is higher than the standard, and we use an A for that. When it is favorable, we use an F. So let's look at example number 5. The standard cost, which we use in example 1, for Lagos Manufacturing Limited, direct materials is 5 kg at 1,000 naira, which is 5,000 naira per unit. Actual production is 1,000 units. Material purchased, we said it was 4,805 kg. And the total cost for those is 4,608,000. Now we are told to find the total direct material cost. How should we do it? Let's start with the standard. 1,000 units. Now that is your standard quantity for actual production. Actual units now, which is 1,000 units, should cost us how much? Our standard price for actual units now, a standard price is 5,000 naira. So if you multiply 5,000 naira by 1,000 units actually produced, it means 5 million. Now, how much did the 1,000 units actually cost us? We are told in the question 4,608,000. And so your total cost variance is simply 392 naira, 92,000 rather. If you want to use the formula method, standard quantity times standard price minus actual quantity times actual price. So your standard quantity, we said we are going to use 5 kg for 1 unit, and we produce actual production 1,000 units. And we said each of the 5 kg cost us 1,000 naira. When we multiply all of these, it gives us 5 million naira. And we were told that our actual quantity was 4,850. How did we get that standard price that we used here? We simply divided the total cost by the standard quantity, and that gave us 950. Because when you multiply, it should give you the total cost that you spent actually. And when we less it from the standard cost for actual production, you are getting the same thing. The direct material total cost variance can be analyzed into their various components, which is price variance and usage variance. So we want to understand, why did we get this total variance of 392? Could it be that the price that was paid for the material is different from the standard price that was fixed? Could it be that the quantity we used for the production is different from the standard that management sets? So you're going to investigate. So let's investigate further by looking at direct material price variance. Let's see if we can get a variance. Now the price variance is calculated. I'll be using the formula method now. Actual quantity multiplied by your standard price. This is the same thing as saying actual quantity, yes, purchased. This is for actual quantity purchased multiplied by your standard price per kg. Then you have your actual quantity times your actual price. So that's it. So if you look at this formula method, in each side of the equation here, each side of the parenthesis, there is something common. Actual quantity is common in both. So when you take out the actual quantity, you can see clearly that you are comparing price. So there is a difference in the standard price and the actual price. That is why it is called a price variance. So given the actual quantity, actual quantity is fixed there, is unchanged, is constant. What is the difference in price that is causing this variance? Now let's look at example 6. In example 6, we are asked to find the direct material price variance, given the whole thing that we are given in example 5. Now let's look at it here. Standard. This is the actual quantity that was spent on. How much should we have spent on it? If we have to spend 1,000 naira per kg, we would have spent 4,850,000. But how much did we actually spend? We spent 4,608,000. And so the variance is a favorable variance of 242,000. This is because we spent less than we budgeted. Now let's look at the formula method to see if we are correct. This is the actual quantity and the standard price. 4,850,000 is the actual quantity, 1,000 is the actual price. Multiply them together, you have 4,850,000, which is the same thing up here. Now, the actual quantity is 4,850, And I told you how we got this, our actual price. When we multiply, it gives you the actual cost. When you less the actual from the standard, you have a positive figure, which is favorable variance of 242,000. That means it is correct. If you have more than two, if there are two or more direct materials, you need to calculate the variances, price variances for each material. So we have just assumed one material here. If there are two materials, three materials, four materials, you will calculate 2, 3, 4, as the case may be, price variances. Now we've seen that out of the variance we got here, 392,000 total variance, total material variance. We have identified that 242,000 of it is from direct material. So we see here is a favorable variance. We have identified where the first one came. It is because of the price variance. So the price was cheaper than we budgeted. Let's look at the usage. Let's go to the usage. The usage variance is calculated by comparing the actual quantity of material used to make the actual production to the standard quantity that should have been used to produce this unit. In other words, the actual usage of material is compared with the standard usage for the actual number of units produced. So let's look at it here. Look at the way we do it. You bring the standard quantity that would have been used for actual production, and you compare it with the actual quantity that was eventually used. You find the difference in quantity. You then multiply it by the standard cost variance, standard cost of one unit. That will give you the usage variance. If you look at the formula method, it's standard quantity, standard price, actual quantity, standard price. What is common to both of them is price, and the price must be standard. So you see quantity differs. So you have quantities being examined. Take note, in price variance, we are comparing standard and actual price. The quantity here must be actual. So we are looking at quantity, it must be actual. When you are doing usage variance, you are comparing quantity, standard quantity with actual quantity. What should be common here is price. The price is not actual price. The price must be standard. So quantity, think of actual. Price, think of standard. Let's go to illustration 7, which is the final example we're going to be looking at. Given the same thing that we got in example 5 and 6, we are told to look for the direct material usage variance. So we start again. If we are to make 1,000 units and we use 5,000 kg, it means that what we'll be having as our quantity is 5,000 kg. Now, how much did we actually use? We used 4,850 kg. And so what's the difference? The difference is just 150. And it's favorable because we use less than we budgeted. Okay, now what is the standard cost? 1,000 naira per kg. So we'll multiply, we have 150,000 naira. Okay, so using the formula, 5 kg is the standard quantity. Actual production unit is 1,000. Standard cost, standard price is 1,000. When you multiply each of them, it gives you your 5 million. And of course, This was the actual cost, actual usage, but at standard cost. That gives you 4,850,000. When you look at the difference, it is 150,000. So previously we have 242 plus now 150. That will give you a total of 392. That explains this 392 we have here. So if you look at it again, this 392 we have as our total variance of material. We attribute 240 to price variance, and we attribute 150 to material variance. It means that the production manager will take the glory for 150 naira, 150,000 naira variance because of the usage variance, while the purchasing manager will take the glory for 242,000 units for the price variance. Now, don't think too that because you have a favorable variance, it means always a good thing. And don't think because you have an adverse variance, it always means a bad thing. We need to look at the possible causes for these variances. What are the possible causes of variances? Now, for price variance, what are the possible causes of price variance? Possible causes for favorable variance could be that suppliers that you used before, you change them. And so you now got a different supplier. And these suppliers now decide to charge you a lower price. Now that's good. That's good. So they charge you a lower price. You enjoy the favorable variance. Okay. It could also be because previously you used to buy smaller quantities, but now you decide to buy bigger quantity, buy bulk purchase. And when you have a bulk purchase, they give you a discount. Now that discount made you have a favorable price variance. But look at another reason for favorable variance. Materials that were bought may be of a lower quantity. And so because they are lower quality than the standard, and so because they are of low quality, they may be cheaper than expected. And so you may have a price variance that is, a lower than expected. So you see here, because you bought a low quality material, you may have a price variance that is favorable. It might go and give you an adverse usage variance because the people who will be using it will be struggling to use it because they are of low quality to lead to wastage and all that. So you see, favorable price variance is not always a good thing. Yes, it could be because you bought them at a lower price. It could be because you bought them at a discount, but it could also mean you bought substandard. What are the possible causes of adverse material price variance? It could be that the suppliers you changed to now charged you higher price than your former supplier. That will cause adverse. It could also mean that suppliers increase their prices. Your present supplier, maybe you didn't change your supplier, but your current supplier increased his price more than expected. Maybe because higher prices was caused by inflationary rates, and so they increased their price, and you didn't put that into consideration. It will now cost you a higher price spending, higher an adverse variance. Then it could be that there was a severe shortage of materials. so that prices in the market were much higher than expected. Maybe when there's a scarcity, with fuel, when there's scarcity, they may want to increase the price of fuel. And so that may result to a higher adverse price variance. Or it could also mean a good thing too, that you bought a better quality than what you were planning in your standard. And so because you bought something of better quality, the price was expensive. Now that we've seen the possible cause for price variances, which could be favorable and which could be adverse, let's look at the material usage variances. What are some of the causes for material usage variances? One of them, for favorable variance, could be that wastage rates were lower. What do we mean by wastage rates? In production, we have what they call normal loss. That is normal wastage. If you have planned your normal waste to be a certain amount, and in the actual terms, you now get a lower than that, you'll be getting what they call abnormal gain. And that is caused as a result of normal wastage being lower than expected. And so it will cost you favorable material usage. That's cool. Then it could also mean that there are improvements in production methods, and that improvement may make you use your materials more efficiently. Maybe because you were using manual before, you now decide to use mechanized way machines to make your production more, efficient, and you have a favorable variance. What about adverse variance, material usage? Could be that wastage is higher. What could make your wastage to be higher? It could be because, one, like this last part says, materials used were of cheaper quality than standard and result in more materials being thrown away as waste. And so that made your waste to be higher. So because the purchasing manager wants to increase his variances, more favorable variance, buy cheaper material, but it become a problem for the production manager because they have to throw away some of them as waste because they are of substandard. It could also be poor handling. So it could be poor handling of the product. Maybe the people who are in the production department are not adequately being trained. Maybe because, labor turnover, people leave and the labor turnover rate is high. People leave and people come in, and you need to train them and retrain them, and they still have not gotten it well. Poor handling of material. Could also be mistakes, and it will lead to wastage of material. So normally, adverse variance is because of wastage, while adverse and favorable material usage could be because of management of the quantities used. Price variance could be because of getting good prices, getting a bulk discount, but also getting a substandard favorable. So adverse could be because of inflation, because of increase in prices. So you need to look at the question. The question might give you a lead as to what may be the cause of the variance, because you might have a question asking you to give the variances, the total variances, investigate and break the variances down to their material and usage variances. And they might ask you, what are the causes of these favorable or adverse variances. So you be ready to explain to the lecturer, to the examiner, all that you do. So far, we've talked about standard costing. We now developed it into preparing a fixed budget. And we now said fixed budgets are so rigid. When we get the actual result, we cannot compare them together. It's going to be unfair. So we now have to look at a flexible budget, which will help us to compare with our actual results to see if we really did well in the period or we did badly. Then that comparison will make us to get a report called a variance report, which will be used to reconcile the fixed budget profit with the actual profit we have recorded. We now went ahead to look at direct material variances. We look at the total material variances. We now broke them down into their components, price, and usage variances. We looked at what is favorable variances and adverse variances, and we investigated the causes of those variances, why they are favorable and why they are adverse. So please read this very well, because when you understand material variances well, you'll be able to understand labor variance and variable overhead variance, which will be taken next class. Then we'll also include a fixed overhead variance. Then after that, we'll be looking at sales variances. And when we look at sales variances, we will now be seeing how we can reconcile the fixed production profits with your actual result. That's a reconciling statement. After we've done that, we'll now be looking at advanced variance analysis, which is when we'll be taking variances to an advanced level to see when we need to revise our budget. Now that's a fixed budget being revised, not a flexible budget this time, a fixed budget needing revision. And so we take it to another level. So these are the things we expect in the next 2 weeks. So thank you so much for coming to class. The video will be presented soon, and you will need to watch it and ask your questions where you deem fit. Once again, thank you so much, and I'll see you in the next class. Good night.